Welcome to the Deep Dive, the show that cuts through the noise and delivers the most important nuggets of knowledge, custom tailored for you. Today, we're plunging into the formidable world of Equinor, a true global energy giant. I mean, think about the sheer scale. Every second, the world's consuming hundreds of thousands of barrels of oil, billions of cubic feet of natural gas. It demands companies like Equinor operate on this, massive, high-stakes financial playing field. We're going to unpack their latest Q2 2025 analyst call and their detailed financial statements. Our mission today, pretty clear, distill what's truly significant here for you. Maybe you're prepping for a crucial meeting or just trying to grasp the pulse of the energy sector. Or perhaps you just have that insatiable curiosity about how these titans navigate such a rapidly changing world.
And Equinor's Q2 results are fascinating, really, because they represent this powerful tension. You've got a company deftly balancing the colossal profitable might of traditional oil and gas with the accelerating yet often challenging transition into ambitious renewable energy projects. And all this is happening within a really volatile global market. So we'll be scrutinizing the hard financial figures, but also their strategic moves across different energy types, and even getting into some key insights on their environmental performance. It's almost like a battlefield report from this epic clash, revealing who's winning, where the pain points are, and what it all means for the future of energy itself.
Okay, so against that backdrop then, all that geopolitical turbulence and market shifts, how did Equinor actually translate that into their bottom line? Let's dive into the headline financial figures for Q2. What's the core story?
Well, the core message from Equinor themselves is one of solid financial results. They reported an adjusted operating income of $6.53 billion before tax for Q2 2025. Now, their IFRS net income, that's their profit under the International Financial Reporting Standards, the global accounting rules, that was significantly lower, only $300 million.
Wow, quite a difference.
Yeah, but that number was heavily impacted by a large impairment. We'll definitely need to dig into that later.
Okay.
Their adjusted earnings per share, EPS, came in at NOK 0.64. And their year-to-date cash flow from operations after tax remained very strong, $9.2 billion. So this solid performance they talk about in such a turbulent market, it isn't just about good numbers. It really reveals Equinor's unique ability to leverage its diversified portfolio, its operational agility to capture opportunities others might miss. It's a testament to their resilience in a truly unpredictable global landscape.
That's a good summary of their internal performance, yeah. But Equinor operates within this global ecosystem that's been, to put it mildly, a bit of a roller coaster. What kind of external pressures was Equinor navigating this quarter, and how much of that can they actually control?
You're absolutely right. The energy markets, they just continue to be roiled by geopolitical unrest, ongoing conflicts, significant uncertainty around tariffs, trade wars.
Yeah.
It creates intense volatility, especially in oil markets, and specifically in the European gas market, they highlighted lower storage levels, almost 20 percentage points lower than last year and well below the 5-year average. We also saw warmer weather in Europe driving additional gas-to-power demand and less liquefied natural gas, LNG, coming to Europe because Asian demand was higher. So in these uncertain times, Equinor's stance was very clear. Focus on what you can control. That means operations, maintaining resilience, and upholding strict cost and capital discipline.
Right.
Their stated goal for the year was flat cost development, and their capital expenditure, their CapEx guidance, remained firm.
Okay, those financial figures are impressive, but they're built on the ground level reality, right? The actual production. What's the story there? Where is Equinor extracting its energy this quarter, and what does that signal for their growth trajectory?
Right, the production side. Their total equity oil and gas production for the quarter was 296,000 barrels of oil equivalent per day. That's MBOED, the standard way to measure combined oil and gas output.
Right.
And that's up over 2% from last year's Q2. What's particularly notable, though, is that they are on track to deliver 4% production growth for the entire year. That's quite strong for a company of this size.
That is a significant growth number in what's often seen as a mature industry. Let's start with their home turf, the Norwegian Continental Shelf, the NCS. Any standout fields driving this growth? And what's the long-term picture look like for this, foundational region?
Absolutely. The Johan Castberg field is a truly impressive achievement. It ramped up to its plateau production, 220,000 barrels per day in less than 3 months.
Wow, less than 3 months.
Yeah, it's fast. And the oil from there, high quality. It's realizing a premium of around $6 per barrel compared to Brent.
Yeah.
Plus, they made a new oil discovery, about 9 to 15 million barrels right there in the area. So that could potentially add to reserves. Then you've got Johan Sverdrup Incredibly high regularity, 99%. And a final investment decision, an FID, was made on Johan Sverdrup Phase 3. That's expected to increase recoverable volumes by another 40 to 50 million barrels of oil equivalent.
Mm.
And this project, along with some innovative water management and multilateral drilling techniques, well, it enabled them to increase the recovery rate assumptions for the entire field from 65% up to an astonishing 75%.
75%. That's incredible for a basin that's been producing for decades.
It really is. It pushes the boundaries of what people thought was possible. So overall, NCS liquids production is up 4%. Now, there were some challenges, planned maintenance shutdowns like Hammerfest LNG that impacted things slightly.
Sure, maintenance happens.
Exactly. But all these efforts actively support maintaining production levels on the NCS all the way out to 2035. Equinor is maturing over 200 improved oil recovery, IOR projects, and 200 prospects to achieve that long-term stability.
Okay, well, their home turf is performing exceptionally well for a truly global energy giant like Equinor. The real story often lies in their international plays, doesn't it? What's standing out beyond Norway's borders? Particularly, you mentioned their U.S. onshore gas operations.
Yeah, that's where a fascinating development emerges. If you look at their U.S. onshore gas production, it increased by an incredible 50% in Q2.
50%.
50%. This was largely due to strategic transactions they made last year, like those Marcellus play acquisitions from EQT. And what's even more significant is they captured almost 80% higher gas prices for this gas compared to, say, Henry Hub prices.
80% higher prices.
Yep. Well, it's partly the location in the Northeast, near demand centers, and maybe some savvy marketing or hedging. But it really highlights Equinor's sophisticated long-term bet on natural gas. They see it as an enduring transition fuel, a vital part of the energy transition and the electrification of the world. And the location of that Marcellus gas, Northeast U.S., it fits perfectly with the growing demand from data centers, the AI boom. It sort of challenges the conventional wisdom about how fast decarbonization will happen, signaling a strategic embrace of gas for decades to come.
Interesting strategic positioning there. What about other international areas like Brazil?
Right. In Brazil, they announced the divestment of the Peregrino field. Headline value is $3.5 billion, though net proceeds will be less due to effective date adjustments and such.
Okay.
But this allows them to focus on developing Bacalhau first. Oil expected this autumn, and Raia, which is a domestic gas field, expected around 2028. So Brazil definitely remains a key country for them. And overall, that increased U.S. onshore gas production more than offset the production loss from divesting assets in places like Nigeria and Azerbaijan back in 2024.
Right, right. Now, Equinor's made a very public commitment to renewables. How did their clean energy portfolio perform this quarter, and what significant strategic moves did they make in this, well, rapidly evolving space?
Okay, renewables. Their total power generation from the renewables portfolio was 1.1 terawatt hours, or TWH, in Q2. The renewable power generation part specifically was 0.83 TWH. That marks a significant 26% increase from Q2 last year.
It's a solid jump. What drove that?
Mainly the ramp-up of Dogger Bank A in the UK, that huge offshore wind farm, and new production from the Lingsåsa onshore wind farm in Sweden. They also reached financial close in Poland. They secured a massive project financing package, EUR 6 billion, for the Baltic 2 and 3 offshore wind farms. And they noted this was on what they called favorable terms, supporting double-digit equity returns.
Favorable terms, huh?
Right.
That's interesting, given all the headwinds and challenges we hear about in the offshore wind sector globally right now. Why would they consider these terms favorable?
That's a really important question. They didn't elaborate deeply on why in the call, but securing such a large package in the current climate at all might be seen as favorable. It likely reflects the specific project's strength, maybe Polish government support or Equinor's strong relationships with lenders. But yeah, it definitely stands out against the broader narrative.
Okay, so that sounds positive, especially given the market context. But then we also saw news about a significant impairment related to their U.S. offshore wind projects. That looks like a major setback, doesn't it?
Yeah.
What exactly happened there? And how does Equinor rationalize moving forward despite such a large write-down?
Yeah, that's the other side of the coin and a critical piece of the puzzle. Equinor made an impairment of $955 million in the quarter.
Ouch.
Yeah, the main driver. Unexpected changes in regulatory frameworks for future U.S. offshore wind projects. The biggest chunk of that, about $763 million, was directly related to the South Brooklyn Marine Terminal. The thinking was its development assumed future projects would use it as a hub,
Right.
but under the current framework conditions, that now looks unlikely. Other factors were higher tariffs on steel and a smaller amount related to a previous stop work order.
So it's a big hit. How did they justify pushing ahead with Empire Wind then?
Well, while the impairment certainly leads to lower life cycle returns on Empire Wind, Equinor's CFO stated quite clearly that moving forward with the project was, in their view, the best way to protect value for shareholders. What's fascinating here is the broader context they provided. On a portfolio basis, their offshore wind projects that are already in operation or execution still delivered double-digit equity returns.
Okay, so the impairment is specific.
Exactly. It highlights that this impairment is specific to certain U.S. challenges, the terminal, the regulations, rather than a sign that the whole offshore wind sector is failing for them. It seems like a calculated decision. Absorb a hit now to secure future value rather than walking away entirely.
That's a complex decision. And it brings up another important point about how they value these projects. The analyst call mentioned a 3% discount rate for the Empire Wind impairment. That seems really low, especially compared to their oil and gas investments. Can you shed some light on that difference? What does it tell us?
Yeah, that 3% number definitely catches the eye. It's a key distinction, and it highlights the very different risk profiles they see. That 3% discount rate used for impairment testing, it's an unlevered, real after-tax discount rate.
Okay. Unpack that a bit.
Right. Think of it as a baseline rate reflecting a very, very low-risk cash flow stream. For comparison, their oil and gas investments typically use a much higher 5.5% discount rate. Why? Because those revenues are exposed to volatile commodity prices, big swings up and down.
Makes sense.
The justification for the lower rate in renewables projects like Empire Wind is that their revenue profile is essentially fixed for 25 years. That's locked in through long-term power purchase agreements, so there's a much higher degree of certainty compared to oil selling at whatever the market price is tomorrow.
Got it. Fixed revenue, lower risk, lower discount rate for accounting.
Exactly. But, and this is crucial, you have to distinguish this accounting rate from their investment hurdle rate. When they actually decide to invest capital in a renewables project, they still aim for a significant premium. They target double-digit returns on the equity they invest.
Okay, so the hurdle to invest is much higher than the rate used to check for impairment later on.
Precisely. The impairment test uses a low rate because the revenues are fixed, but the decision to invest in the first place requires a much higher expected return to justify putting the capital there instead of somewhere else, like oil and gas. It's not about how much they paid initially, but what they expect to earn on their equity investment over time.
That's a really important distinction, thanks. Now, beyond specific projects, Equinor has also been busy securing major long-term gas supply contracts across Europe. What's the significance of those deals for their strategy and maybe for the broader European energy market?
These contracts are highly significant, yes. They recently announced 2 large, long-term agreements to supply gas to the UK and Germany. For example, one with Centrica in the UK for 55 TWh per year for 10 years.
10 years is a long time in today's market.
It is. And these aren't just simple commercial deals. They demonstrate that major players in Europe are signaling a clear, continued need for Norwegian gas for power production, for industry, for decades to come, as Equinor put it. It really emphasizes the critical importance of security of supply right now.
So locking in demand for Norwegian gas.
Exactly. And while these contracts are generally priced based on spot market prices, they offer Equinor what they call free sourcing, basically, full flexibility in how they manage their gas production system on the NCS to meet these commitments. And if you connect this to the bigger picture, these contracts represent about 20% of Equinor's total natural gas position on the NCS, and they cover something like 6% of total EU gas imports. That indicates a pretty significant long-term commitment to European energy security amidst all the current global uncertainties.
Okay. And looking further ahead, what about future projects like the Wisting discovery up in the Barents Sea? What's the plan there? How does that fit into this larger strategic puzzle?
Wisting. Yeah, that's a promising discovery up north. Equinor is actively working to mature it, bring it forward to an investment decision, possibly next year, maybe later. They seem to believe it has the characteristics to be a good development.
So it's still on the cards.
Definitely seems to be. It's part of that broader risk portfolio, as they call it, for maintaining NCS production through 2035. It shows they're constantly looking to replenish their pipeline of projects, to ensure that long-term energy supply continues.
Okay, let's pivot back to the financial mechanics then. How is Equinor managing its balance sheet? How are they allocating capital back to shareholders, especially with these large investments happening and all the market volatility?
Right, the balance sheet. Their net debt to capital employed ratio, it increased to 15.2% in Q2. Now that jump was primarily technical. It was due to the Norwegian state's share of the share buyback from last year being booked as finance debt on their books. It was a $4.141 billion liability that they actually paid off in July after the quarter ended.
Ah, so a timing thing mostly.
Largely, yes. Despite that jump, the company emphasizes they have a robust financial position and expect the ratio to stay around current levels. They see their target range of 15–30% for gearing not as an absolute target, but as something consistent with their credit rating ambitions. It gives them flexibility.
And shareholder returns,
Thank
dividends, buybacks.
Still a priority. The board approved an ordinary cash dividend of 37.7 per share for Q2, and a third tranche of the share buyback program was approved up to $1.265 billion. That includes the state's share again starting July 24th and ending by October 27th. Their total expected capital distribution for 2025 is holding steady at around $9 billion. That's in line with what they've communicated before. They stress they're committed to remaining competitive with their peers on capital distribution, but without using a rigid formula that directly links it to cash flow fluctuations.
Got it. And what about that relentless focus on cost control you mentioned earlier, especially in this inflationary environment? How are they actually managing to keep a lid on operational expenses?
Yeah, they reported flat cost development in the quarter, which, as you say, is their goal for the year. That's quite an achievement given the broader inflationary pressures we're seeing everywhere.
Definitely.
Their unit operational expenditure, OPEX, costs on the NCS, are stable at $6.07 per barrel. They're actively fighting inflation, neutralizing its impact through various initiatives. Things like strong pushes on efficiency, significant reductions in early phase and business development costs, and also lower staff costs, partly through limited external recruitment.
So tightening the belt internally. What about external market costs? Drilling, construction.
They noted some softening in the market for high-end floating drilling rigs, and they expect pressure in Norwegian engineering and construction to ease up maybe in about 12 months. However, they see Asian shipyards, the subsea market, and marine sectors. Those are expected to remain tight, mainly due to all the ongoing construction of floating production, storage, and offloading vessels, FPSOs.
Right. Okay, this brings us to a really crucial point for anyone analyzing Equinor, isn't it? How that unique Norwegian tax system fundamentally impacts how their capital expenditures and cash flow look compared to international peers. It almost feels like a secret weapon for Equinor sometimes. Can you explain how this works and why it's so critical for investors to grasp?
It absolutely is. This is such a key point for critical thinking about Equinor's financials. If you just compare Equinor's CapEx number, which is pre-tax, to its cash flow from operations, which is after tax, it can be highly misleading if you don't factor this in.
Okay, how does it work?
Think of it this way. For pretty much every dollar Equinor invests in a new project on the Norwegian continental shelf, the Norwegian tax system effectively gives them 78 cents back almost immediately in the form of tax deductions or uplifts applied as the money is spent.
78%. Wow.
Yeah. It dramatically reduces their actual cash outlay for that investment in the year it happens. So their after-tax cash flow relative to their capex looks much, much healthier than it would otherwise. It makes them appear far more capital efficient maybe than peers when you just look at the headline numbers. You have to compare them on an equal basis, adjusting for this massive tax benefit.
So it fundamentally changes the economics of their Norwegian projects and incentivizes that investment.
Exactly. It's a huge factor in their financial structure and performance metrics.
That's a massive distinction to keep in mind.
Yeah.
And just quickly, what about the recent changes to Norway's tax payment system? How does that impact their cash flow modeling?
Right. Norway changed the payment structure. It used to be 6 installments per year. Now it's 10 annual installments.
Okay.
So for the second half of 2025, Equinor expects to pay 5 equal installments, totaling about NOK 100 billion, spread from August through December. Then they'll pay 5 more in the first half of 2026.
So more frequent, smaller payments.
Essentially, yes. It's a relatively minor adjustment for cash flow modeling. It just distributes the payments more evenly throughout the year. But it's another one of those unique aspects you have to factor in when analyzing Equinor because they operate within that specific national framework.
Okay, so we've navigated Equinor's second quarter. We've witnessed this powerful balancing act, haven't we? Between their traditional strengths in oil and gas, impressive milestones like Johan Castberg's ramp-up, and their significant though sometimes challenging, investments in the energy transition, highlighted by, the complexities of U.S. offshore wind impairments, but also those strategic long-term gas contracts.
Absolutely. What truly stands out here, I think, is Equinor's commitment to strategic progress and financial discipline, all happening amidst ongoing geopolitical and market volatility. They're demonstrating remarkable resilience, adaptability, leveraging their deep expertise in oil and gas while forcefully pushing forward in renewables, even when they face significant headwinds like that impairment. Their Q2 results aren't just numbers on a page. They feel like a powerful testament to a company executing a very complex dual strategy in a deeply uncertain world.
Indeed. It makes you wonder. If Equinor can continue to deliver these kinds of results, solid financials, strong operational performance while simultaneously investing so aggressively in both traditional and new energy sources, what does that mean for the future of other integrated energy giants? Are you showing a possible path forward? And maybe what innovations might be on the horizon that could further de-risk or perhaps accelerate that incredibly complex, multifaceted energy transition for everyone? Something to think about. We hope this deep dive has given you a real shortcut to being well informed on this important slice of the global energy picture. Remember, the deeper you dive, the more you discover. Until next time, keep exploring.